when it comes to the mortgage interest itself, we've got a cap for primary residences at $750,000. For the investment property, no cap, which I think is something the young kids are saying nowadays, right? No
No
cap.
cap. That's right. And you will not find any cap here.
No cap here. What's going on, everyone? Welcome to another episode of The Remote Investor. I'm Michael Albaum, and today I'm joined by my co-host,
Pierre Carrillo.
And we're going to be jumping into a question that we actually got from one of our listeners from a past episode that we did. So, Pierre, I'm going to let you kick us off, read that question, give us the prompt, and then we'll jump into it.
Yeah, we recently had a debate episode between whether or not you should buy a investment property before getting into your primary residence. And one of the tenets for investment property was the tax benefits. So the question that we got was, what are the tax benefits for our primary residence compared to those of an investment property? How much do they differ? And are there like pros and cons of both of them? Where do they shine?
Yeah, and I love this question because I think so many people start investing and decide to invest for a number of reasons. Maybe it's the cash flow, maybe it's the appreciation potential, but one of the things that isn't always accounted for, always factored for, is the tax benefits, and that can take this investment from a interesting investment, good investment, to a killer, phenomenal investment. So it's a really good question. And so when it comes to the tax benefits for primary residences, so owner occupants, you buy a house, you're living in it, what are the tax benefits associated with that? There are a couple that I think are pretty notable that we just want to keep track of and bear in mind. Firstly, number one is with regard to the mortgage interest that we're paying on a loan, if we use a loan. So if you go to a bank and you borrow money and you go to buy a house that you're going to live in, you're going to have a loan, and that loan is going to be comprised of two pieces, and that's the principal and the interest in terms of your monthly payment. Now, the principal is just you paying back the amount of money that you borrowed from the bank. The interest is obviously the interest above and beyond what you borrowed, and that's the bank's quote-unquote profit, so to speak. That's the money that they're making as a return on their investment for lending that money out to you. So the interest is actually deductible, but only up to a loan size of $750,000. So if you're out there and you're living in a $200,000 house, it's a primary residence, you are likely going to be able to deduct all of that mortgage interest off of your taxes. Now, for those folks living in California or higher expensive markets, higher price point markets, if you're living in $1 million home, $2 million home, $3 million home, the mortgage interest above that $750,000 price point, or rather threshold, is not going to be deductible on your taxes. So I just want to pause here and caveat all of this with, we are not financial tax experts. Definitely go consult your tax professional before doing anything on your own. But I think it's important to keep these points kind of top of mind as people are deciding what makes the most sense for them, whether it makes sense to invest first or buy a primary residence first. So that's number one. So the mortgage interest up to $750,000 loan amount is going to be deductible on your taxes for a primary residence. Now, we compare that to a mortgage on an investment property. There's no limit. So if you go buy a $200,000 house for an investment property, you'll get the same mortgage benefits of deducting the interest as you would as a primary residence. But if you go buy a $2 million piece of investment property and you've got a mortgage north of $750,000, you're going to still be able to deduct all of the interest against the income and potentially offset your taxes that way as well. So when it comes to the mortgage interest itself, we've got a cap for primary residences at $750,000. For the investment property, no cap, which I think is something the young kids are saying nowadays, right? No cap.
That's right. And you will not find any cap here.
No cap here. No cap here. So that's first and foremost. The second big interest.
Quick question. I'm completely ignorant on this, Mike.
Tell me.
Do you need to be registered as a corporation to take that benefit, or can you still do that in your personal name?
No, you're talking about for the investment property?
Yeah, for the investment property.
No, it doesn't matter. So the tax benefits, now that's a whole nother episode, man. I love the question. Okay. So the tax benefits that you as an individual, Pierre, would get from owning investment property is going to be, I got to say this with an asterisk, universal, independent of how you hold title to that property. So if you, Pierre, go buy an individual piece of property and own it in your personal name, you'll be able to deduct all that mortgage interest off your taxes. If you own it in an LLC, Depending on how the LLC is set up to be taxed, you likely will be able to deduct that again straight off your taxes against the income. Now, if
So the
we start getting
differentiating factor is that you live in it or you don't.
yes, and the
Okay.
the only other difference I'm gonna caveat that with is if you have a corporation. If you're owning this piece of property as part of a corporation, that's where things start to get a little bit different and
Okay.
nuanced.
Don't let me
But
sidetrack you. Stay on
yeah,
on your point. Yeah. I'm
man,
going
we
off
are
of
down. We
it.
could be
Yeah.
down that rabbit hole in an instant.
Sure.
Buying investment property versus the owner occupant and living in it is going to be the big distinguishing factor for most people listening. So now moving on. So the next big tax item that we want to be cognizant of is for owner occupants, again, primary residences. We can deduct up to $10,000 of property taxes off our taxes. So depending again on where you live, that number might seem extraordinarily high, and you might not even come close to paying that in annual property taxes. Or you might be someone like me that lives in again high cost of living area, California. Property taxes are north of there, and so I don't get the full benefit of being able to deduct all of the property taxes that I'm truly paying in a given year against my taxes. But $10,000, a lot of money, nothing to snuff at. Again, we compare that against the investment property, limitless. If I'm paying $30,000 a year in property taxes, which I'm getting kind of close with some of these properties that have high tax markets, I get to deduct every single dollar against the income of that property, and so it's going to show up on my taxes. So two big ones. Those are probably going to be the two biggest players when it comes to tax deductions for owner occupants as compared to investment properties. Now, a couple other ones I was looking up this morning, which I found to be pretty interesting because it's not something that I'm super well versed on because I don't do my own taxes. I just keep track of all the expenses that I pay for basically every property I own, whether it's a primary or it's an investment property. And I give it to my tax professional. I'm like, you figure it out. Here's all the money I spent. You get to figure out how to categorize it and figure out where the deductions need to go to best benefit me in any given year. But another thing I saw was that PMI, private mortgage insurance, which is something that if you put down less than 20%, your lender is likely going to require that you have. It's an extra insurance that the lender has that you're going to be paying on a monthly basis as the owner. That is likely going to be a deduction on your taxes as well. Now, depending on the size of your loan, this number might be significant or it might be kind of peanuts. But again, I think it's important to capture every dollar that you're spending in hopes of getting a tax benefit because it's money you've spent anyhow, or it's money that you have to be spending. So you may as well get some benefit for it. So PMI is another one. Another one to keep in mind is home upgrades. And so when I was reading about this, I was kind of scratching my head. I was like, oh, well, I'm putting in a new kitchen. Do I think that'll qualify for a deduction? But the more research I was doing, it turned out to be required, quote unquote, or necessary renovations. So like making your home more ADA compliant because maybe you're in a wheelchair, or aging in home upgrades might be able to be tax deductible against your taxes for primary owner occupants, which is I thought kind of a unique and interesting thing to keep in mind.
Don't let me derail you and let me know if you're going here, but I have a question about house hacking. Do
Tell
any
me.
of these tax benefits come into play for owner occupants if they are house hacking?
Yeah, man, I'm so glad you went there because I was over here. I'm always over here, and you brought me right back to where I need to be. So this is great, man. So
Okay.
real quick, let's just define house hacking for anyone that might not be familiar with it. It's buying a property to live in that has more space, units, rooms, square footage, however you want to define it, than you need, and you can rent out the additional space, units, rooms. So this is something that my wife and I did when we moved to the Bay Area. It's really expensive to live here, so we intentionally bought a duplex. It cost us more on the front end to buy that, but then we were able to rent out our second unit to help offset our cost of living, mortgage expenses, that sort of thing. So it's a really great way to build wealth. It's a great way to get started in real estate because you get so many of the benefits that come with owning investment real estate while solving for your primary residence needs as well. So we debated this on that episode that you, Tom, and I did about whether it makes more sense to buy a prime residence first or invest in investment property first. And house hack is I think just a real sweet spot. It checks a lot of the boxes. So your question was, hey, Michael, what tax benefits do you get as a house hacker, and kind of what bucket does that fall into? Is it the primary residence bucket, or is it the investment property bucket? And the answer is it's kind of both. And from everything that I've understood, again, not being a tax professional, what the CPA or the tax professional does, or if you're doing the taxes yourself can do, is you just need to break down the expense load on a pro rata basis based on the square footage of what's a rental versus what's primary residence. So let's just use simple math here. If we say, hey, the duplex that I was living in is 50% split between my unit and my rental unit on a square footage basis, that means I'm going to be taking all of these benefits. I would bucket them as an investment property, so I get to take every single benefit, cut it in half, and that dollar amount is what I get to deduct as my house hack. Now, what likely, because we can kind of split hairs here on this, that property happened to cost more than $1 million. So if it was just a primary residence, I would only be able to take the mortgage interest up to that $750,000 mark. But because it's half investment property, what I think happens, and don't quote me, and if somebody listening knows the answer to this, please let us know and write in. But this is my shot in the dark. This is what I'm gonna guess happens. Because I'm living in the property, I get to take $750,000 of the mortgage interest and write it off anyhow. Now let's call it $1 million purchase price. There's $250,000 of potential mortgage. Really, the purchase price was, let's call the mortgage is $1 million. Mortgage is $1 million, so I get $750,000 for the primary residence in the mortgage deduction, the interest deduction. So then that leaves $250,000 left in mortgage that I cannot deduct the interest from. But because half of it is a rental property, I'm guessing that I'll be able to deduct $120,000 in mortgage interest off that $250,000. Does that make sense?
Totally. But when you're doing this on your taxes, you just let your tax professional just handle all the details behind all of this.
Exactly. I told him, hey, I don't know how to communicate that message. I've told my CPA, hey, look, these are all the expenses that I've spent. And again, I capture every single dollar because I'd rather overload my CPA, give him more information and have him tell me, oh, you know what, this isn't deductible, isn't deductible, versus him having to come ask for me, oh, hey, by the way, did you spend money on this, that, the other thing? I'm like, here's everything. In a file format, right? I use Excel. I keep track of everything, and I label it. I date it. I put the expense, cost, as opposed to like giving him a shoebox full of receipts. Like, here you go, dude. You figure it out. So have a system to be able to convey that information. And then I've told him, hey, this is the square footage breakdown. This is what our unit is. This is what our rental unit is. And then he goes from there. So PMI we touched on. Upgrades we touched on. A couple other ones to keep in mind that are great are if you are obtaining a loan when you go to buy your primary residence and you are buying down points. So what a point is basically if you're prepaying the interest up front. And so if the interest rate that the bank gives you is say 6% for your mortgage, you can pay a fee up, which are called points, and buy down the interest rate to maybe say 5%, just using random numbers here. So that way your monthly payment is lower. And so it's always important to keep track of if buying points makes sense. And there's a real quick and easy way to do the math. We basically take the original loan payment on a monthly basis, and at 6%, let's use random numbers here. Let's call it $3,000. And if you wanted to buy points, let's say it costs $10,000. Again, making up numbers here. But that would drop your new monthly payment at the 5% interest level to say $2,500 a month. So what we do is we're going to take the difference in those two payments, which in this example is $500, because we said our original payment's $3,000, our new lower payment's $2,500 of $500. We put that to an annualized number. So 500 times 12 is $6,000. And we divide that by the cost of the points, the upfront cost, which is $10,000. So what we see is that 6,000 divided by 10,000 is 0.6. And we want to convert that to a percentage. So we're going to multiply it by 100. And we see that's a 60% return on investment. So another way to think about that is what's the payback period in which we are going to receive all of our money back for that initial investment. Again, the initial investment's $10,000. So the way to determine the payback period is we actually flip that equation. So we flip that and we say, okay, we spent 10,000 and we're essentially saving, quote unquote, $6,000 a year. How long is it going to take us to recoup our money? And what we see is that's 1.6 years or 20 months. So what that tells us is that if we plan to be holding this mortgage for more than 20 months, it makes sense to buy the points, because after month 20, it's a net savings. Versus, yeah, I'm only going to be in the property for a year, or I'm only might hold this mortgage for 18 months. I'm not really sure what my plan is. It may not make sense to pay that $10,000 up front to save $500 on the back end. So points, that was a very long-winded way of saying points are a tax deduction for owner occupants. So when you go buy a property, you're going to get a closing statement, sometimes called a HUD, sometimes it's called a CD, a closing disclosure is what that acronym stands for. It'll spell out all of the expenses that you had associated with buying the property. So you had your deposit, then you had your escrow taxes, your escrow insurance, any points you paid, lender fees, all that sort of stuff. A lot of these are going to be tax deductible. So definitely keep track of that. Definitely give that to your tax professional come tax time. Again, if you're buying a primary residence. Again, same exact story for investment property. Every single dollar you spend on the closing and purchasing of property is going to be a tax deduction. So those two are fairly equivalent. The last exemption or tax benefit that we get as owner occupants that's actually massively different than investment property is when it comes to capital gains. So there is a rule out there, an IRS rule that says if you sell an owner occupant property that you've lived in for 2 out of the last 5 years. So we take a 5-year snapshot looking in reverse. And if you've lived there for cumulatively 2 of those 5 years, you can sell that property and get a tax-free capital gain of $250,000 as a single person or $100,000 as a married person. And I think it depends on how you're filing taxes. Or maybe not. I don't know. Ask a CPA about that one. But that's the rule. Is it $500,000 as a married couple, $250,000 as a single person? So what that means is if you bought a property for, and let's use easy numbers here, $500,000, lived there for 2 years, moved out of it, had it as a rental for the last 3, and then sold it for $750,000, you would get that $250,000 gain. Now, granted, of course, there's commissions and fees associated with selling a property, but we're going to forget about that for just a minute because for the thought experiment, that $250,000 gain that you made, let's say you're a single person, is going to be tax-free. So this is like mind-blowing when you start to understand the impacts of this, because now you can take that $250,000 and go invest it. You can go leverage that into a new property, a new primary residence, a new investment property. You know, it is to do with it what you choose. As compared to, we take that same scenario as an investment property. You go bought a $500,000 investment property. You probably aren't going to be living there for 2 out of 5 years because you bought it as an investment property. You're really not supposed to live in your investment properties. And so then you sell your investment property 5 years down the road for $750,000, and you still have that same $250,000 gain, but you're going to be taxed on that very differently. There is no exemption for a tax-free gain on an investment property. Now, we do have 1031ing. Yeah, that's exactly it. You've got the 1031 exchange, which is a tax deferral strategy, which allows you to sell a property, reinvest all of the proceeds into a new property, and you have to basically step up. So if you owned this property and you're like, man, I kind of need the $250,000 for something, you wouldn't be able to get that tax-free. You would be taxed on that gain, or partial gain, depending on how you split it with that 1031. If there was any boot, which is basically money that you didn't used on a future purchase, on the next purchase after selling that piece of investment property. So the capital gains exemption for owner occupants is wild. And I mean, I hear stories about people buying in owner occupant properties, renovating them, so kind of doing like a live-in flip, and then selling them after a couple of years. And you can make $500,000 tax-free gain. I mean, you think about it, you do that twice in a 4-year period, you just made $1 million tax-free. Like, this is
sounds like it beats all those little nickel and dime tax benefits on a small investment property.
Big time. Big time. So the question, of course, is, well, does it make sense to sell the property versus keep it as a rental? I'm a big believer in converting old primary residences into investment properties. Again, if you can, if you're able to hold on to them and you maybe don't need the money for your next down payment, and then getting kind of so many of these benefits, getting able to double dip. So you have the owner occupant benefits while you're living there. Then you convert it to a rental. Now you've got all the rental tax benefits, and then you can sell the thing after 3 years and still get some of those owner occupant exemptions and benefits as well. And I think for a lot of people listening, this is something that my wife and I did. We were really tight on cash buying our newest primary that we live in now. And we really wanted to keep our old house hack because it was a duplex. It was in a great area. We had fixed it up. It was just renting like it was its job, and we had a 2.875% 30-year fixed rate on it.
You
so
can't
it's
get
like,
rid of that.
You can't get rid of it. Yeah, we
Yeah.
can't sell it. So we said, okay, how do we leverage this into our next house? And what we did is we ended up getting a HELOC, a home equity line of credit, on that original house, and then use that to help fund our down payment on the next house. Now, there's risk associated with this, of course, because the HELOC's interest rate are variable. And so we now have kind of 2 mortgage payments. Well, technically it's 3. We have the original mortgage payment on the house hack. Now we've got the HELOC. I call it a mortgage payment, but it's really an interest-only minimum payment, but we pay principal on it as well. And then we have the traditional mortgage on the new house as well. So it's a hefty debt load for sure. But one of the things that helps me sleep at night is, I know what the maximum interest rate can be on the HELOC. And we're paying it down every single month. We're making principal payments. So our interest only payment is decreasing. And so the amount that we owe on it is decreasing. We're kind of snowballing it. And the house that we have the HELOC on is a rental that's producing cash flow above and beyond the existing mortgage that we have on it. So I'm basically taking all that money, throwing that at the HELOC as fast as I can to pay it down. So I don't consider this HELOC as a long-term debt solution. It's very short-term for us until we can get it paid off as fast as we can. Because right now it's sitting at 9%. And so that kind of stings a little bit when I'm thinking about, man, I have a 9% mortgage in effect. So we're paying it off as quickly as possible. But the alternative was sell that house hack for cash, for money, and use that to get into the new property. But then at the end of the day, we would be in a worse off financial position if we take a whole snapshot of the picture in terms of monthly cash flows. And so I said, no, I would rather have this variability HELOC hanging over our head, knowing that we have a plan to pay it off and a plan to execute it, but keep the rental, because if that's what it takes to keep the rental, we're willing to roll the dice on that. So in thinking about converting old primaries to investment properties, again, for somebody that maybe needs the cash that's tied up in that property, doesn't want to touch the loan, or doesn't maybe want to sell the property, either getting a second loan or a home equity line of credit can be a really great way.
Sounds like a very passive investing.
What I did is I started making boxes. I literally drew it out and I said, okay, this is the house and this is the debt load on this house. I have my primary mortgage it costs this much, and then I have all these expenses and they cost this much. And then if we do this, we're going to have this HELOC, and this is another box, and this is what the HELOC payment is right now, and this is kind of what it could go up to. And I just grouped all that together and I said, okay, that debt load for owning and operating this piece of now rental real estate is going to cost me X, whatever that number is. And I'm of the mindset that's like, okay, because of the HELOC is associated with this house hack, I'm going to put the debt cost there, as opposed to saying, oh, well, the HELOC is technically attached to this first property, but I'm using the proceeds to buy property B, so I'm going to say the debt load is there. It's 6 of one, half a dozen of the other, because the payment's the same regardless if you call it attached to property A or attached to property B. But for me, mentally, it just made sense that I said, okay, this is the debt load that's associated with this address, with this house hack. Am I comfortable with that debt load based on the rental income that property is generating? And then I've got my second house, the new prime residence we moved into, totally separate. And if the answer to that question is yes, I said, okay, we're golden. And that's what my wife and I did. We sat down and we said, yes, we're comfortable with this because of all the A, we're comfortable with it just straight off the bat, and B, because of all the tax benefits and added benefits that we now have a rental property in a market that we live in the Bay Area that we believe in. And it allows us to leapfrog into this next property as well. So we were super fortunate that we were in a position to do that. But it took planning. Like, it didn't just happen all of a sudden. So I think if people out there are listening, thinking that, oh, they might want to move into a new property at some point as a primary residence from where they are currently living, if they own their existing primary residence, everyone should consider converting it to a rental and just going through that thought exercise. You could very well come to the conclusion, yep, doesn't make sense. This new debt load just is not supported by the rental income. So let's sell the thing and move to a new primary and kind of wash our hands of it. Or you can think about, hey, what are these different strategies we can leverage to keep the initial property and get into the next one?
Very cool, Mike.
Makes sense?
Yeah, it does. It's not as bad as I imagined it at first.
Yeah, I mean, it's, again, like you said, it is complicated, but it's not that complicated. It's just different. It's a little bit different than 20% down on a new house and then moving in. There's some additional pieces involved here that I would encourage, again, everyone to consider if you own a prime residence and are thinking about moving.
You have to have a certain level of comfort in the uncertainty too, because you're kind of depending on, like, what do you have, like a stop loss in place on the property if it stops renting? Like, what's the threshold for you to say, okay, we got to get rid of this? Because a 9% HELOC to service with no renters seems like a hell of a burden.
Yeah, so it's a really good question. Part of it is that we are so confident in this property's rentability. So when we were living in it as a house hack, we had it was upstairs, downstairs duplex. So the upstairs unit, we did short-term Airbnb, VRBO rentals, nightly rentals. We had our license with the city to do that. And then we also did monthly midterm rentals, all furnished. And what we found is, and I've talked about this on other episodes, is that the monthly rentals, or 1 month, 3 months, 6 months, whatever the duration is, just the non-nightly rentals, while it didn't generate as much revenue in terms on a monthly basis, it was a lot less work and a lot less headache. And so my wife and I decided, hey, let's just convert this thing to kind of a monthly rental and not have to worry about it. And so we did that, and we had a lot of success there. Now, since we've moved out of the property, we now converted our unit to a full-time rental, and we had a tenant move in, and they signed a 2-year lease. They've got kids going to school in the area. They wanted some security, so they signed a 2-year lease. Upstairs tenant, they signed a 6-month lease originally, and they're like, we want to stay. We love it here. We don't have any plans to leave. So what that tells me is that in 18 months, 19, maybe 20 months of living there and operating short-term rental, midterm rental, and long-term rental, the vacancy rate has been so low across all those different types of rental classes. And so we know, we being my wife and I, that the rental demand is really strong. And so if we had a tenant move out, we could likely have a new tenant in there fairly quickly that meets one of those 3 criteria to whether a short-term, midterm, long-term. I love the question because you have to think about the downside risk and how to minimize and mitigate those risks. Our stop loss, we're not real worried about it, but at the end of the day, worst case scenario, knock on wood, both tenants just stop paying rent for whatever reason. It's in California, so there's all kinds of tenant-friendly laws here, right? What do we do? Got to have reserves. Like, there's no question about it. Just because you've got a really strong tenant base or really strong rental history doesn't mean you don't have reserves. And so we have this HELOC that, it's interesting. I mean, we could essentially use that as reserves because we didn't max out the HELOC to go for our new down payment. We took a portion of it. So we still have access to a line of credit that, hey, if we're in dire straits, we got to fund this mortgage on a monthly basis. Otherwise, we risk losing the house. I would tap into that for sure. Because the question then becomes, well, do you try to go get the thing re-rented and stop the bleeding, which it would be our first choice? Or do you say, you know what, let's cut our losses and sell the thing? Well, the HELOC is going to get paid off from any sale proceeds. And so I would rather not have a foreclosure on my record and have a little bit higher HELOC balance to close out on the sale of the property. And selling a property takes a little bit of time. You got to prep the property, get it staged. Well, it probably already would be staged because we've got all of our furniture in there, and my wife used to work as a stager. So the house looks awesome, if I do say so myself. A little bit biased. Shout out to my wife, Claire. So it takes time. And so all the time that the house is getting prepped, getting ready to sell, you still got a mortgage payment to make. And so we would probably fund those things with our cash reserves or from the HELOC. And we would figure out which to draw on first if that time did come. But no, I love the question, man. I think it's super important to be thinking about and be cognizant of.
Sweet. I can ask you more about that, but I think we're getting off the original topic here and we're running up on time. So
yeah. So short story long, some of the tax benefits to think about if you have an owner occupied primary residence as compared to a investment property. You do still have tax benefits as an owner occupant. They are just not nearly as robust or as extensive as a investment property. Whereas at the end of the day, the investment property, every single dollar you spend owning, operating, maintaining that property is going to be a tax deduction. So be very mindful of that and try to understand the two if you're trying to compare what makes most sense. At the end of the day, from what I've seen, most people are not making their decision based on tax benefits. They're making their decision based on other factors, whether it's a need for housing or the financial incentives associated with simply owning rental property, the appreciation associated with that, the financing of that compared to owner occupied properties. So the tax benefits tend to just be a cherry on top. But I love the question from our listener. Thank you so much for reaching out and asking because it's important to have all the facts and all the numbers in front of you when making that decision. So what do you think, Pierre? Should we get out of here?
Let's go.
Awesome. Thanks everyone so much for hanging out with us. Really appreciate it as always. We love to hear from our listeners. So if you have a question that you would like to get answered, please let us know in the comments. We will try to answer it on our next episode. Hope you enjoyed it. Hope this was informative. Again, go talk to a tax professional before doing anything on your own related to taxes. You'll be glad you did. All right, everyone. We'll see you on the next one. Happy investing.
Take care.